Sister Saira, I think we should start, Brother Majd.
Yes, Brother Umar. Sister Hora is going to be opening the.
Distinguished participants, dear colleagues, Assalamu alaikum wa rahmatullahi wa barakatuh, wa salatu wa salam ala nabiyyina Muhammad wa ala alihi wa sahbihi ajma'in. It gives us a tremendous pleasure today to welcome you to this public hearing session on the exposure drafts of IUFI Financial Accounting Standards on Deferred Delivery Sales and Istisna-based development contracts. IUFI has previously addressed these aspects of financial reporting requirements in FAS 7, Salam and Parallel Salam, and FAS 10, Istisna and Parallel Istisna, which were identified for revision during the comprehensive review and revision project initiated by the IUFI Accounting Board. The public hearing is one of multiple steps in standards development process at IUFI and represent an opportunity for us to interact with and benefit from the knowledge, experience, and wisdom of professional individuals and experts from all corners of the industry on the newly issued EDs. This event is held in collaboration with the State Bank of Pakistan, and we would like to thank them for taking the efforts and extending their support in organizing today's public hearing. On this occasion, we would like to welcome Dr. Zahid Al-Rahman, Director of Islamic Finance Policy Department at State Bank of Pakistan, to give the opening remarks. Dr. Zahid, the floor is yours.
Thank you, sister. Assalamu alaikum, everyone. Good morning to everybody. I'm really pleased to welcome the Secretary General, Brother Umar Mustafa Ansari, all the distinguished guests and members of the IOFI, and the scholars, industry practitioners, and the participants who are participating and giving time for this important step of the standard setting process. It is a privilege for us to be here today on this important public hearing on these two exposure drafts. As Sister mentioned, one exposure draft is on financial accounting standards on deferred delivery sales, and similarly on the Istisna-based development contracts. What I'm really pleased that IOFI has been actively revising and updating its existing accounting standards. And similarly, it has issued a series of new accounting standards in the recent years. And we believe that there's a comprehensive, most of them have been already revised. So inshallah, we are hoping that soon this revision process will finish. And of course, the simultaneously new standards will be also issued, work is already going on. And for these two standards, if we look into this one, like this deferred delivery sales one, I mean, Murabaha is one of the major product in the Islamic finance industry. Similarly, some banks are doing Salam as well. So these two contracts enable businesses, especially the trading sector, the agriculture sector, to access financing without resorting to interest-based instruments. The proper accounting treatment of these transactions ensures that revenue recognition, risk assessment, and financial reporting remain aligned with both Sharia principles and international best practices. On Istisna-based contract, it's especially important for the infrastructure financing, real estate development, and industrial production. And today we shall seek feedback on this standard, which covers financial reporting obligations associated with the Istisna contract. And I believe the parallel Istisna is part of it, ensuring consistency in recognizing obligations, cost, and revenues. So by providing a structured framework for these contracts, the standard will ensure, just like others, broader adoption and streamlined financial reporting across the markets. Now, let me just talk about the relationship between IOFI and State Bank. I really feel obliged to say that IOFI has consistently played an important role in developing Sharia-compliant financial accounting, Sharia, governance, auditing, and ethics standard. Its contributions have significantly enhanced the integrity and credibility of Islamic finance institutions across the globe. At State Bank, we deeply value the long-standing partnership with IOFI. We are a regulatory member of IOFI, and our relationship is built on shared vision of promoting Islamic banking and finance across the world. By adopting and implementing IOF standards, Pakistan has made substantial progress in aligning with regulatory requirements with international best practices. Now, let me talk about specifically on what we are doing for the implementation of IOF standards in Pakistan. So we are working on multiple fronts. So one is that we have started working on the implementation of adopting Sharia standards for the Pakistani market. And we have a very comprehensive regime in which we work with the local Sharia scholars, the members of Sharia boards, and the Sharia Advisory Committee of the Central Bank to implement the IOF Sharia standards for the Pakistan. And simultaneously, we are also considering these governance standards. Recently, we are working on a standard on investment accounts regulation, and we are considering the IOF's expert draft on this subject. And on accounting standards of IOF, we are also helping, working with SCCP, with ICAP, to inshallah move forward on this aspect as well, inshallah. Now, you have spared time for these public hearings, and as you all know, that this is actually a very important part of the entire Senate setting process. The working group does a lot of hard work, of course. It reviews, it prepares some document, but unless there's a, I would say sometimes there are very critical comments, but these are important part of the process. So you give the comments, you share your thoughts, you share your experiences of your company, your organizations, and your countries, which help to make these standards more comprehensive, more practical, and reflective of industry needs. So inshallah, we hope that with this process, with this public hearing, we will be part of, we'll be able to make consensus, and inshallah, we'll be able to finalize the standard with this process, inshallah. So at the end, I would like to conclude my opening remarks by again thanking Secretary General Badr Umar Mustafa Ansari and IOF for its efforts, and also for all of you for participating in this session, which shows your dedication towards the development of Islamic finance. And I'm confident that discussions we will have today, inshallah, will pave the way for a more robust standard, inshallah. May Allah grant us wisdom and guidance to achieve the objectives of these standards and to continue our journey towards establishing an Islamic financial system that is ethical, fair, and lead to prosperity of all our nations. Thank you and wassalam.
Thank you, Dr. Zahid. And again, thank you for your collaboration and support. Now, and without further ado, let me invite to the virtual floor the Secretary General of IOF, Mr. Umar Mustafa Ansari, who will present the EDs and walk you through its main content while also answering your questions in an interactive session. Brother Umar, the floor is yours.
Thank you very much, Sister Haura, and thank you very much, Brother Dr. Zahid Rahman Kukar. Thanks for the management of Central Bank of Pakistan for supporting our lot of initiatives, including this one for supporting this event. As Brother Zahid, you have already highlighted the significance of this part, so I may not be going on this one, but let me just take you through the main discussion part. Before going to the main discussion, I would say that something is very important to understand on two aspects. Number one, what is the basis or rationale for having these standards? And to some extent, when some of these treatments are different from other accounting treatments, like in IFRS and others. So while details will be discussed in due course, but one fundamental point I would like to emphasize, that I emphasize again and again. The whole starting point is where Allah subhanahu wa ta'ala says, وَحَلَّ اللَّهُ الْبَيْعَ وَحَرَّمَ الرِّبَى, that Allah subhanahu wa ta'ala has permitted trade transactions and prohibited riba transactions. If I take you back to what else is there in the same ayah, وَيَقُولُونَ إِنَّمَا الْبَيْعُ مِثْلُ الرِّبَى. And these people, those non-Muslims or mushrikeen, they used to say that This trade transactions or these trade transactions are similar to interest transactions. And this is where the question comes as to how and whether and to what extent you can distinguish these transactions from each other. While at times you feel that the eventual objective achieved for both the transactions is the same, the modus operandi and the transaction execution and the steps of transaction execution become different. And this is where we need to understand a few fundamentals. Without understanding those fundamentals, we won't be able to understand why this standard is there, or like existing standard, and why we are revising the main standard. How to put it is in easy words, I'm just thinking. So let me put, like, there are 3 or 4 simple rules. Number 1, Sharia does not allow you riba, that is money on money. Number 2, Sharia allows you trade transactions. So there are different forms of trade transactions which can generate revenue. These can be spot sales transactions. Those can be deferred delivery sales transactions, as we are going to talk more about today. Those can be deferred payment transactions or credit transactions, credit sales transactions. So this can be a deferred payment sale or credit transaction like what we have in Murabaha. We may not like it a lot, but Tawarruk technically is a deferred payment transaction on one side and spot on one side. So technically, what we do in Islamic finance, we replace the conventional interest-bearing transaction with a trade-based transaction. And in the case of the transaction that we are going to discuss today, in case of a trade transaction where the delivery of goods is deferred. So let's go one by one, simple rules which are very important. Number 1, no money on money. You cannot earn money on money, that is tantamount to riba. Number 2, you can have sales transactions of different forms, spot, deferred delivery sales, deferred payment sales, or like there can be different structures for that, different types and characteristics of those transactions. Number 3, you cannot combine 2 contracts in one. You cannot mix up, like, halal with haram. If you cannot combine, like even in case of salam and parallel salam and istisna and parallel istisna, you cannot combine the transactions. In case of salam and istisna coupled with ijara or agency or service ijara transactions, you cannot mix the transactions. You cannot combine 2 contracts into one. You need to understand the process flow of the transaction. The process flow of the transaction is the one that gives you the triggering points for when the ownership transfers, when the risk and reward transfers, when the ownership right on the sale proceed is established for the seller, and what is the point of revenue recognition. What is the point of point and timing of recognition of assets, recognition of inventories, etc., whatever applies. And one important point that we normally signify its importance every time, that is that in Islamic finance, na'uzubillah, you cannot make fool of Allah subhanahu wa ta'ala by just saying, oh, we made this bunch of paper to make it halal, but we are doing exactly what the conventional is doing. Rather, we say that we are trying to do what is halal, what is permissible, and we try to stick to the essence. So we believe at AOFI, we believe in substance and form of the transaction being similar to each other, and we believe that faithful representation includes the element of substance of the transaction, which should be and should necessarily be aligned with the real legal form of the transaction, which is permissible. These are some of the key points. You all who are into Islamic finance accounting and who have read AOFI's other standards must understand these things, but you would be like, needing these principles. We need to go back and forth to these principles at different stages to see where do we stand. Thanks to Sister Horace that she identified the basic need process. So I'll not be repeating it, that there was a comprehensive review process. And so initial background you already got. But one thing is very important. We need to understand that AOFI's newest accounting standard development strategy and the which these standards are being revised are aligning the transactions with generally accepted accounting principles more and more, subject to two conditions. I have mentioned them again and again. We officially communicate these again and again. So first, if there is a very specific Sharia issue, we have to keep us distinguished from conventional. I will come to these examples. Where do we stand? The second is that if there is a unique business model issue of Islamic finance, then we at times prefer a different treatment from the conventional, because conventional is not the conventional accounting under IFRS or other country standards is not primarily focused on Islamic finance or the structure or the business processes of Islamic finance institutions. So before we go to all this discussion, these are the points. One thing is important to understand, that we have tried to align more with IFRS. So we have aligned with to a significant extent with the five-step model of revenue recognition under IFRS. We have again, that five-step model is part of our framework as well. So technically, our alignment with IFRS has improved with this one. But yes, if anybody try to consider Islamic Bank as conventional purely, so in that situation, we may have some difference of opinion. Other than that, we are very simple that we try to align with IFRS unless there is a pure Sharia issue or a business model issue. We'll come to all of it. This background and some of these pointers were very important to be mentioned. They are all part of AOFI framework. They are all part of other AOFI standards. So before we actually review the standard, review the significant changes, and review the new requirements which were not covered, like some of the product structures which are more common, like Salam with agency and Istisna with agency. Parallel Salam is not that common, but Salam with agency is quite common. These type of structures that were not properly covered in the earlier standard. The basic accounting was available, but the detailed structure and detailed requirements were not covered, which have been improved in this new standards. So with that, I will now take you through the standards. Just one thing, I can see some comments coming to the comment window, to the chat window. The request is that please put all the comments in the Q&A tab, please. The comment I can see from there is one comment. I have comment related from whom it is. Actually, from in the chat window, Al-Fahal Abdullah. I have comment relative to other FAS standard in order to give my point to develop FAS 16. Okay. First thing is, kindly put your comment in the Q&A tab with explanation so that we can handle it there. So, just a request, if anybody who want to put any comment, please put your comments in the chat window. We'll in the Q&A tab, not in the chat window. In the Q&A tab, we keep track of all the questions and we make sure that we answer them, or we take them as comment to the respective working group and the board. With regard to the other standard, if you have any comment, particularly with regard to FAS 16. Now, FAS 16 is history. I don't know why particularly you have a point on FAS 16, but we'll take that comment. Please, if you can kindly explain the comment. If anybody want to speak and want us to allow use of mic and video, that normally we see if the time is allowing it. Normally, the number of questions and comments normally don't allow us to do that, but we will see if it is possible towards a bit later stage of the session today, inshallah. But kindly put your comments in the Q&A tab. Inshallah, we'll try to make sure that each one of them is addressed. So at this stage, I can take your permission to just share the standard. Okay, I think before going to that, I might need one more minute to understand, to discuss a couple of points. Earlier we had FAST for 7 and 10. Now we are talking, when we started the revision process, we considered the common aspects between Salam and Istisna transactions, because FAST 7 was on Salam and FAST 10 was on Istisna. And we identified certain structures of Salam and Istisna that work exactly in the same manner. On the other hand, we identified certain structures of Istisna which are completely different. When we identified that FAST 10, which was in Istisna, was not addressing some of the structures of short-term deferred delivery sales transactions based on Istisna, the common example being export Istisna. We have export Istisna in some of the markets where against export order, the whole lot of production is routed through a Istisna transaction to make it make funding available for production process. Just one example. This one technically works similar to a Salam transaction, except for that in case of Istisna, it is a permissibility to have not having full advance payments. In Salam, it is always a requirement that full advance payment need to be made. But in case of Istisna, it's a possibility to have a deferment of advance, not full payment of advance, deferment of payment, and even payment at the time of delivery. So the payment options under Istisna are flexible. Other than that, but you all understand that accounting is not primarily driven by cash flows. Accounting is primarily driven by the transfer of risk and reward and the triggering events for recognition of assets and liabilities and revenues. So from that perspective, we believe that it is important to characterize the transactions which are similar in nature in one standard. When we were applying the 5-step model, we identified that some of the unique Istisna products, which are long-term infrastructure Istisna products, they need a revenue recognition on a percentage of completion or some other appropriate basis to be recognized over a period of time, as compared to one-time single spot revenue recognition. This is very important due to the unique business model and certain characteristics of those transactions. Such characteristics have been identified in the standard, so I'll take you through that. But we understood that this part might be needed. So eventually, although we started the revision process under one standard, and we thought at one point that we may come up with one single standard, but later we ended up developing 2 exposure drafts. That would also be one of the areas where we would be requesting your comments. But let me now share the screen and take you through the main changes first, the principal changes, and then we'll go to the body text of the standard. Okay, so I hope my screen is shared. So first, I'll just take you through the significant changes very quickly. The revised standard has been drafted after combining and aligning the requirements of 2 earlier standards that address deferred delivery sales, including transactions based on both Salam and Istisna, excluding Istisna-based development contracts addressed in their respective AOFI phases. The financial reporting requirements prescribed by the revised standards are aligned with the requirements related to control, transfer of control, and revenue recognition as prescribed by the conceptual framework and the relevant AOFI phases. The predecessor standard included certain Sharia requirements which have been included in the revised, have not been included in the revised standard, and accordingly this standard shall be read in conjunction with the respective AOFI Sharia standards. Our old standards, at that time, AOFI was not developing Sharia standards separately, and the key Sharia requirements were included within the standard and as appendix to the standard. So effectively, now we are making sure that Sharia issues are addressed in Sharia standard and accounting issues are addressed in the accounting standard, and both are integrated. So now all our accounting standards are to be read in conjunction with the relevant Sharia standard. But accounting standards do not define what can be done and what cannot be done. They define, since Sharia requires this need to be done this way, so this is the accounting of this thing. This is the approach. The relevant definitions have been aligned with the definitions provided by the respective Sharia standards, and the revised standard prescribes financial reporting requirement from both the buyers and sellers perspective. This is also one of the important points.
Brother
that
Amal, the
all-
screen is not showing. It's only on the first page.
Okay. I think we had this problem earlier also. Zoom is having this problem for like some time. So let me share without when I convert to PowerPoint show, the Zoom is having a problem. I think now you can see the screen. Can somebody confirm, please?
Still.
Not yet.
Not
Yeah,
now.
okay.
Now we can.
Okay, you can see it now. Am I right?
Yes.
Okay.
Comment, brother,
So-
to increase the display size if possible.
Yeah, that has just increased actually. That
Yeah,
I
okay.
already increased. That is, but more than this, it will be out of. Yeah, this is the maximum.
Okay.
Okay. So I hope it will work now, but our apologies, but we have found this problem in Zoom, like, for last couple of meetings and events, that at times when you convert to PowerPoint show, it doesn't work. And maybe it's my Zoom, something unique happened to that. Anyway, so the revised prescribed financial reporting requirement from both perspective, buyer and seller perspective. Earlier standards of AOFI were generally from the bank's perspective, but now we are keeping the accounting requirements from both perspective. AOFI has had earlier changed its mandate for Islamic financial institution plus Islamic finance transactions. This was one of the arguments against some of the AOFI standards, that their adoption results in inadequate accounting because counterparty accounting is not defined. So, or a mismatch is there. So from that perspective, we have now ensured that all our new standards include the counterparty accounting as well. The next is this standard and aligns the requirements related to impairment, credit losses, net realizable value, and onerous contracts and commitments. Sister Sarah, can you make a note here? Onerous contracts, oblique commitments. Okay. With the requirements of the respective OFI phases, the treatment and financial reporting requirements for parallel seller and parallel Istisna transactions have been simplified and are now based on the applicable treatment for the seller and the buyer respectively. The agency-related accounting treatments have been clarified in case of a deferred delivery sale transaction structure involving an agent. Accounting requirements with respect to subsequent changes in the terms of contract and goods have been simplified. On the contract or in the goods have been simplified. Okay, so let me see. I could see earlier there was a comment coming, a couple of, okay, we already have like a lot of questions in the Q&A tab. Okay, so first question from Brother Sayyid Imtiaz Abbas Hussain. My question is to Dr. Zahid of SBP. When will the State Bank of Pakistan switch over to Islamic Sharia system from the riba-based system, as many economic developments are stuck up for want of this SPP transformation? Brother Zahid, would you like to answer this one, sir? Because although it's not related to today's public hearing, but it is something, important for the majority. Brother Zahid is online or he's dropped out? Okay. Brother Imtiaz Abbas Hussain, thank you very much for your question. We'll pass on your question to the State Bank of Pakistan. The quick understanding that we have is that by the beginning of 2028, the central bank and the authorities are bound to convert the whole system in Pakistan to a riba-free system. After the judgment of the Federal Sharia Court, there was a constitutional amendment in that as well. You might be aware of it. We are working closely with the SBP. We are actually working with SBP, the Afghanistan Bank, and others, and other important central banks in the countries where there is a major transformation effort going on. Those also include Libya, and to some extent Iraq is also working significantly on those parts. So we are working closely with multiple central banks. We have offered all support to Central Bank of Pakistan for working together to help finding solutions of the challenges, etc., that are there in way of this thing. But constitutionally, we understand that this is required to be done by 1st January 2028. Thank you very much, and still your question will be passed on with your contact detail. Sister Marjan, Sister Sarah, just make sure, because Brother Sayyid Imtiaz Abbas Hussain has provided his email address as well, so we can pass on his message to Brother Zahid.
Noted, brother.
There is a question from Brother Imam Falanu Jamil. What is parallel salam? If you allow me to answer it when we come to the definition, so I just answer you when we reach the definition. We'll read it out. There is comment from Brother Muhammad Imran. Revenue and profit recognition. Revenue shall be recognized at gross value at the time of sale of subject matter. Why not we think to recognize revenue based on provincial profit? I think you are talking about provisional profit distribution with regard to distribution of reporters, like in Pakistan, it's being done for running musharaka. I'll come to that part. It is very important question that you raised, so I'm not answering it right now. Brother Nasir Bajaju, most welcome. Okay, then we have a couple of comments about the press screen. I think right now you all can see the screen, and I have zoomed it to a reasonably big level. It's a bit unfortunate that it's not working well, but thanks everybody for your kind comments about this one. I hope it should be good enough for reading on the screen. But if still you guys feel any problem, please answer that. With regard to the revenue recognition and with regard to the parallel salam, I'll answer the questions as we move ahead with the presentation, inshallah. Now let's first go to the before objective. I think we have to go to the name of the standard. With your permission, I'll take you to the name of the standard, deferred delivery sales. Now, the point is that we had some discussion on this point, that what should be the appropriate name of the standard. The appropriate name of the standard would be just a second. Apologies for some disturbance through the messages. I had to stop it. Okay. So on the name of the standard, the discussion or debate was more about I just received a couple of more questions, one more question. I'll just come to answer that a bit later. Let me try to explain the debate on the name. So then the first possibility was that we call it Salam and Istisna standard. The second possibility was that we find a combined name for the standard. When we developed FAS 28, we combined two standards. There was one standard on Murabaha and one standard on deferred payment sales. And we combined it, Murabaha and other deferred payment sales, as a single standard, considering that 90% of the characteristics of the transactions were similar. Only Murabaha had some specific characteristics that were to be identified. So considering these together, we came up with a single standard, because the purpose is to align the requirements as far as possible and to standardize the accounting practices. Here, it was the same question that to what extent we can combine the practices that are there, considering this thing as like, you know, a common transaction structure, particularly for the short-term transactions, it was more appropriate to come up with a common name. We decided that common name should be as deferred delivery sales. Now, the question is, at this point of time, shall we keep the name as deferred delivery sales, or we call it deferred delivery sales, salam and istisna, or we call it salam and istisna. If we call it salam and istisna, there is one catch to it, because if you see that there is a long-term istisna-based transaction, the thing separately as well. So what will be the name of the other standard then? So the possibilities, Sister Saira, can we do a poll on that one as well? Because that will be helpful. I think we can put the three options. That one, we stick to the first name, deferred delivery sales. The second option, we put deferred delivery sales, salam and istisna. Third, we say it's salam and istisna. But
Yes, brother, we'll do a poll.
I think in the working group, we had another fourth option as well. I'm just thinking what was the fourth option, if you can recall. Otherwise, at least if you can do the poll based on these three. Okay, because this is something that we need to be sure that the name of the standard should be well understood and should be properly explaining what are the contents of the standard. So now let's go back to the objectives and start with the objectives. The objective of this standard is to prescribe the appropriate accounting and financial reporting principles for recognition, measurement, presentation, and disclosures to apply in relation to deferred delivery sales transactions comprising salam and istisna sales transactions. See paragraph 5A for the buyers and sellers of such transactions. This standard applies to accounting and financial reporting for deferred delivery sales transactions carried out under Sharia principles and rules by the Islamic financial institutions and other institutions following UFI accounting standards, except for those istisna transactions that are excluded from the scope under paragraph 3. This we are talking about long-term infrastructure transactions. This standard shall not apply to istisna-based development contracts. This standard shall also not apply to such istisna transactions whereby the institution, being a buyer of the subject matter, has intention to either lease out and eventually sell or otherwise transfer the subject matter under Ijara Mutayyib Tamleek arrangement to be accounted for in line with the requirements of the respective UFI FAS, that is FAS 32, use the subject matter in its own operation, self-use or self-consumption. Sister Saira and Marjan, please make a note of it. In what we have written as to be accounted for, we need to check, like, appropriate standard wording that we use. I think at times we use it here, which shall be accounted for in line with. Just make a note of it that we'll have to check whether to be accounted for is appropriate here or which shall be.
Okay.
Okay. Now coming to definitions, before definitions, if we have any comment on this one, I can see some comments in the chat window, but I'll not be able to address those. Okay, Brother Sadaqat, Assalamu alaikum and welcome, sir. Brother Sadaqat has suggested deferred delivery sales under Salam and Istisna. Sister Saira, if you can add this one also under Salam and Istisna, but honestly, Brother Sadaqat, I'm not sure under would be a very good word here, but again, as Brother Sadaqat has suggested, sister, you can add it to the poll. Thank you very much, sir. Now, deferred delivery sales are the sales transactions carried out in line with Sharia principles and rules based on either salam or istisna contract, whereby the primary performance obligation under the respective contract is delivery of the subject matter. Deferred delivery sales do not include such sales transactions that are promised to be carried out on a specific future date against a unilateral promise or undertaking to sell or purchase which are consummated through an offer and acceptance on such future date in line with Sharia principles and rules. Istisna is a contract to sell a described asset with deferred delivery based on a manufacturing request. In practicality, it's a sale contract between the buyer and the seller, whereby the seller, based on an order from the buyer, undertakes to manufacture, have it, get it manufactured, or otherwise acquire the subject matter of the contract according to the specifications and sell it to the buyer for an agreed upon price and method of settlement, whether that be in advance by installments or deferred to a specific future date. Sister Marjan, you just need to check the uniform spelling for installments under the British UK English. Istisna-based development contract is a contract of Istisna for development of an asset meeting the criteria as defined in respective UFI phase. That is the other phase that we are going to discuss today. Paragraph 5D of this standard defines it. Istisna-based development contract within the scope of the standard is which will be scope of the other standard. Okay, is a contract of Istisna for development of an asset, normally an item of property, plant and equipment or investment property duly meeting the following criteria. A, it involves a significant element of effort on the part of developer, including labor and services which need to be compensated for in the event of force majeure in line with Sharia principles and rules and customary practices. Sister Marjan, just make a note of it. If it is on the original standard in bullets, then it should come in bullets. If it is in text like AB, then it can remain in AB. But if I remember correctly, in the original standard, it's AB in the bullets. So it should appear as AB in the bullets here as well.
Okay.
It has been either on an element of partial control transfer. This is very important to understand. It has either an element of partial control transfer through milestones-based delivery and or construction development on customers' owned property, or otherwise defines multiple performance obligations as a part of contract that may individually be assessed and used as criteria for determining stage of completion. So first condition is human effort. It's not only sale, significant element of effort is involved. Second condition, partial control transfer through what we call stage delivery or milestone-based delivery, or if the construction or the installation of the asset is being done on the property owned by the customer. Third, the subject matter is intended to address certain specific needs of an identified unique customer and hence may generally not have a ready market or may not be in a condition, position or location suited for its sale to a third party. And D, it has a considerable original total development period comprising of a single or multiple phases or tranches. Explanation. Development period in the specific context of this definition should not be confused or considered interchangeable with deferred delivery period. So maybe you deliver after 3 years, but development period is the key for this one. So if I have a promise of delivering a car after 3 years, while the car's manufacturing time is only 1 month, then and I'm just delaying it because of other reasons, for example, supply and demand and other issues, then that is not a long-term development contract. Long-term development contract is where the original period of development is long-term. So what would be long-term in development contract? For example, Istisna for building a dam, Istisna for maybe building a ship, maybe installation of a generator in a factory of a generator, or maybe like cooling unit, or like the what we call the district coolant plant or something like this on a property owned by the purchaser. So these are the situations. Just I'm giving examples. There can be more examples that those will be outside of the ambit of this standard, and they will be subject to the other standard. Now you can all see the poll is on the screen. Keep the title as deferred delivery sales. Change it to deferred delivery sales, Salam and Istisna. Change to Salam and Istisna. And change it to deferred delivery sales under Salam and Istisna. So there are 4 options that are on your screen. Please, all of you are requested to answer this poll. I'll continue discussion. In the meanwhile, you all are requested to answer the poll. Parallel salam, I think this was a question. So it is an arrangement whereby the seller enters into another independent salam contract with a third party to acquire goods, the specification of which corresponds to that of the subject matter specified in the first salam contract, so as to fulfill the obligation under the first salam contract without making the execution of the second salam contract dependent on the execution of the first one. In contemporary customs, such second contract is called parallel salam. Explanation. In practice, the sequence of execution of the 2 independent salam transactions may vary according to the transaction structure. So, I am the bank. Let's assume Sister Marjan is the customer. She wants financing for maybe 6 months. And for example, she's growing some apples on apples. She has a apple orchard, or she has some trees. Now she wants financing. We can have an agreement that according to this specification, she will deliver apples after 6 months. I will be, as bank, making full advance payment today. That advance payment made today will be available for her for use. And her responsibility is to deliver me the apples after 6 months. Now, what happens that, for example, her apple orchard or farm is no more able to deliver the exact quantity, or she might want to sell that one early and want to deliver me later. In that situation, she can have an agreement with brother, for example, with brother Majd or brother Harun, who has a farm adjacent to her farm, and they have the same specification of apples. So it is quite possible that she can have another parallel salam contract with brother Harun and use that to deliver eventually to me. But my contract with brother Harun will not be direct, and these 2 transactions cannot be combined as per Sharia. Normally, salam is done with agency. How it works? Normally, what I will do that I will assign an agency to Sister Marjan that you can, once the delivery date is due and you deliver it to me and it is under your constructive possession after that delivery, you can sell it in the market, and we can have a formula of pricing as a agency commission to her, which ensures that I get reasonable margin on my price, and over and above even she can take. This is what is the normal model under which salam works in different markets. Again, we have countries where salam has been practiced very well. We would love to have more comments from those countries in particular. We know Pakistan has some good examples. Sudan has a lot of good examples. We know that certain other markets also have good examples of salam transactions. We understand that parallel salam transactions are not very common, but parallel salam transactions are useful to how I would say, to sell the portfolio of salam in case of need. So it is a liquidity arrangement that can be done. Similarly, parallel salam can be done if the seller is unable to deliver the quantity or the quality of the intended subject matter of the transaction. So considering this, our standard name has not been kept as earlier it was salam and parallel salam, because for us parallel salam is not very common transaction. For us, rather salam with agency, based on the market practices that we have seen, salam with agency is more common. In some situations, salam with the murabha is also there. I could see today, friends joining from Dubai Islamic Bank. We will highly appreciate receiving their comments in particular, because we know that there is a very specific reverse salam product that is being used by Dubai Islamic Bank, which is one of the good examples of innovation in Islamic finance. We would like to learn more from them. And if they feel any practical problem, although we know that UAE adopts our Sharia standards today, UAE doesn't adopt our accounting standards at this point of time, although we hope that it will be done soon, inshallah. But considering these type of unique products, it will be good if we can have the right feedback available to us. So this is answer to your question as well, brother, who raised the question about parallel salam. I think it is clear. I have explained a couple of examples about some of the unique transactions or the common transactions that are there in the market. But again, we are open to all discussions. Let me just complete the definition section and then take the open question and answer whatever are there now. Parallel istisna is the arrangement whereby the seller developer enters into another independent istisna contract with a third party to acquire through manufacturing development of subject matter according to the specifications of the subject matter specified in the first istisna contract as to fulfill the obligation under the first istisna contract. In contemporary custom, such second contract is called parallel istisna. Parallel istisna is executed only if so allowed by the buyer customer in the first istisna contract without making the execution of the second istisna contract dependent on the execution of the first one. Explanation: in practice, the sequence of the execution of two independent istisna contracts may vary according to the transaction structures. A common example that I used to give in the training sessions, let me take that example, very simple, quick example. For example, there is a shipping company. That shipping company wants to purchase a ship. Again, you know, ship is obviously quite expensive. And when you want to purchase a ship, and particularly a new one, there is a significant development time involved. So now shipping company went to the shipyard, ship manufacturer, and the shipyard says that, okay, we will manufacture the ship according to your specifications for $100 million. Now, they say that we want 60% of that $100 million in advance and 40% you can pay at the time of delivery. That's it. You cannot, there is no deferment of credit or all that. Now, the shipping company is not in a position to get this much financing available immediately, so they go to a bank. Now, that Islamic bank becomes the purchaser from the shipyard and makes payment to shipyard according to 60% and 40%, whatever is their payment requirement. And then under a parallel istisna contract, sells the same ship to the shipping company. But the shipping company makes only 10% advance payment, and it makes, like, for example, 10% payment on delivery, which is after 2 years or 3 years, and then 10% payment every year. Again, obviously, the profit element has to be added on to that. So this is one simple example in which a parallel istisna works. Now, the example that I have given is about the long term. Now, short term, how it works? There is an exporter of garments. That exporter of garments has received a purchase order from an importer in another country. Now, there has to be a letter of credit and all the security for that is needed according to the banking and payment system. So now what happens that this party, the manufacturer, needs 70% advance payment or 80% advance payment to purchase the raw materials for the garments and to pay for the labor and everything. But that amount is not paid by the importer in advance. Importer says, I will pay after 6 months of at the time of delivery or at the time or after 6 months of delivery with a credit. Now, what happens that at this stage, again, the bank becomes a financier under a Istisna contract. And under the Istisna contract, it asks the manufacturer to develop manufacture or construct whatever is needed. Like in our case, it is garments, so it has to get the garments ready according to the given specifications. So the specifications are kept the same. Now what happens that this garment exporter will deliver to bank, and bank will authorize him to sell as an agent to export it, or if the first contract is a Istisna contract, that can be made a contract with the bank. So this technically becomes a parallel Istisna. So it can take form of a parallel Istisna contract or Istisna with agency contract. In some situations where the bank may not take the legal position of a manufacturer, it will be agency, it will be Istisna with agency. In situations where bank can take the legal position of being manufacturer and buyer both at the same time, it can be a parallel Istisna situation. I'm just trying to give some of the examples to understand what type of transaction structures we are going to deal in these two standards. Now, let me just complete this last slide on the definitions, and then we'll move to this one. Salam is the sale of a pre-specified commodity for deferred delivery in exchange for immediate payment in full in line with Sharia principles and rules. Explanation: it's a type of sale in which the price known as the salam capital is paid at the time of contracting, while the delivery of the subject matter is deferred to a specific time. So having completed this section, let me just go to the okay, before that, can we take the poll? Sister Saira, can we Sister Saira and Haura, can
Yes,
we have the poll now? Poll results now?
The poll
Okay.
results, 72 people participated, and we have 8% who have voted in favor of deferred delivery sales, the current title.
If I summarize, like to keep it, Salam and Istisna is also only 8%. To keep it as deferred delivery sale is also 8% only. But the majority is in favor of calling it deferred delivery sale, Salam and Istisna, or deferred delivery sale under Salam and Istisna. So it is 83% who actually want Salam and Istisna to be in the name. If I remember correctly, that was a suggestion of the Sharia committee as well. So most probably when we finalize the standard, we'll just take it to the board and we'll try to, most probably the board will be convinced after seeing this poll and comments of the Sharia committee as well. So most probably it will be either change deferred delivery sales Salam and Istisna or deferred delivery sales under Salam and Istisna. But because both of these are quite similar, so technically it's 83%, vast majority wants the name of Salam and Istisna to be in the name of the standards to understand the contents of the standard from the title. Thank you very much, everybody, for taking part in this poll. Sister Sarah, I think you will keep the record of this poll for the working group and the board. Thank you very much. Now coming to the comments that are there. Brother Sajjad Zafar has a point. Kindly elaborate what is the difference between Istisna-based delivery sales transactions and Istisna-based development contracts. Brother Sajjad, I think I have taken you through that difference in the footnote that we were discussing. If you still feel further elaboration is needed, please put your comment again. Then I will try to explain it again. But I think after your comment raised, we have gone through that discussion point already. Brother Ibrahim Muhammad has put a point. What about the development of a house? It will consider an Istisna too. There is a difference opinion in some of the scholars on that, but for us generally we will consider as it within the Istisna. There will be one issue only, whether you are doing it on the customer's property or you are doing it on a property which will be sold with that. So for example, one situation is that I include the plot in the subject matter as a constructed house on a plot. And one situation is that house is owned by one person and this other person, that is the manufacturer, is developing house on that one. Now, yes, generally, according to this standard, we have not excluded the house in that one. Although during the Sharia committee discussion, it came that this view of certain scholars that house construction should not be part of it. But yes, as of now, it is included. And even when we talked about that specific situation, when the asset is constructed on the property owned by other, then that obviously can include house. Now, what would be the difference? So, for example, I got my house manufactured, like, for myself. So I had two options of contract. One contract option was that there was a specification agreed. There was a construction plan. There were agreed materials that these are going to be like the material quality, the suppliers, and all that. There was a rate agreed on total, footage, how much square foot construction is there, and there was a rate identified that this much BD would be charged for every square foot. And then according to the total construction plan, total square footage was identified, and based on that, a lump sum price was agreed that this is the price for construction. Option A. For me, it's Istisna. Option B. We agreed that this is the plan, these are the materials and everything, but we said that the purchasing will be done by the customer, by the manufacturer on my behalf, and I will pay him a lump sum amount of X, or a monthly amount of Y, or a percentage of total cost. So what we call cost plus contract. So 10% above the total cost I'll pay to him. The second situation is service ijara situation. Service ijara situation is not included in the current standard. Okay. So Istisna is where identified by in terms of specification, not an existing asset, but identified in terms of specification asset is sold for a future date. In Istisna, sale takes place today, delivery is deferred. This is the situation which is different from service ijara, where service ijara the raw materials and the supplies ownership remains with me, and the manufacturer works as an agent and takes his manufacturing charges in form of a lump sum fee or as a percentage of work done, etc. So all development of house or all construction of house will not be Istisna, but some of them, depending on whether they meet the definitions and characteristics of Istisna, will be considered Istisna. Brother Hamad Khurshid has a very good point, but I'll come to that point later. Then Brother Sayyid Imtiaz Abbas Hussain has another point. Again, Brother Imtiaz, your point is very good, but I'll come to it later. Anonymous attendee has raised a question in the scenario involving a shipping company and a bank. Can the bank sell us the ship at a higher price than what was originally agreed between the shipyard? Yes, exactly. According to Sharia, both contracts should not be linked with each other. So 99% situation, the price will be higher because bank is there to earn a profit. So they will add the profit margin for that, which will include because they will be making payments in advance to shipyard, and then the shipping company will be making payment to them on a installment basis over a period of time. So in order to make it feasible for them, they will have to add a profit margin on that. In the current banking system, normally it will be based on LIBOR, that they will make the whole calculation, and then based on that they will LIBOR or SOFR, SONIA, whatever they are applying, the conventional benchmark rates which are being followed now, they will be adding the margin on that, and based on that they will be charging that price. So yes, the price will be higher. It can be more, it can be equal, it can be less, But what is not allowed as per Sharia and what is not allowed as per this accounting standard is that you cannot combine the two contracts into one. Brother Sajjad Zafar has said that he's okay on that point because we explained it after his point, so it's okay. Thank you very much, Brother Sajjad. Okay, so again, there are 3-4 points about revenue recognition, about stock, etc. So since we have not reached those points, so these may be like, good points raised, but it will be good if we take all the colleagues through at the same time. Okay, now let me move to deferred delivery sales in the books of the buyer. Now, I am the buyer. I have given the order to purchase salam or istisna goods. In case of both, the specifications are defined. In case of istisna, condition is that the manufacturing element need to be involved. And in case of salam, the condition is that the goods must meet the istisna goods, salam goods conditions that are specified by Sharia, and additionally 100% advance payment is made. The payment structure and type of goods may not necessarily distinguish the transaction characteristics from the perspective of control transfer. So from that perspective, both can be dealt in the same way. So advance cash payments made by the customer to the buyer to the customer in the capacity of seller in the salam or istisna transaction shall be recognized as follows. In case of salam transaction, at the time of entering into a salam contract as advance for salam goods equivalent to the amount of cash paid, and in case of istisna transaction, as and when the advance payment is made in lump sum or installments, if any, in line with the contractual arrangements as advance for istisna goods equivalent to the amount of cash paid. Inventories. There was a question related to inventory, so let's handle it here. Inventory shall be recognized by the buyer. So right now we are talking about the buyer accounting. Okay. The common transactions that we are talking about, bank pays advance to the customer. Customer delivers goods to the bank. And then bank appoints customer as agent to sell the goods in the market or to export. This is the most common form of the short-term salam and istisna transactions. So here the bank is the buyer. Okay. So bank will be recording advance. In the last slide, we talked about bank to record advance as much as advance is paid. In case of salam, it will always be full amount of advance. In case of istisna, it will be advance amount equal to whatever you paid. So it will be recorded as advance. Then after the advance, the second stage comes. This stage comes after 1 month, 2 months, 3 months, 5 months, 6 months, 9 months, whatever the time has been defined as delivery time for salam and istisna. At that point, when you get it, till that time you keep advance in your books. And that advance is interest free. Inventory shall be recognized by the buyer once it controls the subject matter of the salam or istisna transaction. That is the time when it essentially acquires the control and hence substantially all risks and rewards incidental to ownership of such subject matter. Inventory shall be initially be recognized at cost. The cost of inventory shall comprise all cost of purchases and other costs incurred in bringing the subject matter to its present location and condition. It includes all types of taxes other than those subsequently recovered, transportation and handling costs, including related takaful cost, and all other costs directly attributable to bringing the subject matter to its present condition, location and condition, including those incurred by the customer in the capacity of agent and any fee paid to the agent. Trade discounts, rebates, performance bonus, and similar items, if any, shall be adjusted with the cost. In case inventory is acquired on a piecemeal basis or in tranches, each tranche of inventory received shall be recognized when the conditions specified in paragraph 7 are met. Okay. So that was initial measurement. Initial measurement of advance, initial measurement of inventory. Now let me answer one of the questions raised there. That is about revenue. At this point of time, I give money. Does Sharia allow me to earn money on money? That's the point that's why I re-emphasized on some of the points in the beginning of today's discussion. What is the difference between riba and rabah on goods? So halallahu al-bay' wa harrama riba. Has bay' taken place when I paid advance? Goods might not be in existence today, but rather technically they are not in existence today. Even if they are not in existence, their full control has not been transferred to me. So for example, let's take the example of me having transaction with Sister Marjan. I paid advance to her to deliver me apples after that point of after 6 months. But just by way of a storm, the trees are either the whole trees are destroyed or maybe only the apples that were in raw stage, they were all destroyed. What happens? Whose loss is it? At this point of time, it is her loss, and she's bound by Sharia to purchase similar apples from the market and deliver them to me on the specific date. And that is the reason that Sharia does not allow the product of salam to be linked to a specific farm or a specific orchard, etc. It has to be open. There is a condition that it should remain available in the market. That is also a condition, because it is a goods liability. It's a commodity liability that is fulfilled through delivery of commodity. So initial recognition at this point of time takes us to a position where we cannot have any return on revenue at that point of time. We'll come to the revenue recognition part later as well, because it is more covered in the subsequent measurement. But there was another comment, because that comment is very important. Brother Hamad Khurshid, now I will take your question here. How do we determine when the stock in a salam contract is considered to be owned and possessed by the buyer? Okay. So according to Sharia, in case of salam and istisna, the transaction takes place, the sales takes place on day one, but the delivery is what concludes the transaction eventually. And till the time delivery is not done, it remains a liability on the seller, a liability, non-financial liability on the customer. So effectively, at this point of time, the stock is not in the ownership. Now we need to also refer to the Sharia issues, like for example, in case of istisna, you have identified the issue of salam, but let's go to the istisna, which is more complicated for that. So for example, Sharia says that even if the manufacturer in istisna has purchased raw materials, the raw materials remain as his ownership, not in the ownership of the purchaser. And that is the difference that I identified between a service ijara based construction contract versus a istisna based construction contract. In a istisna based construction contract, the raw materials and even the manufactured goods, till the time those are not delivered, are in the ownership of the customer, and it has a liability to deliver those goods, but it remains in the ownership of the manufacturer, and any loss before the delivery date is according to Sharia borne by the manufacturer. Now let's go to subsequent measurement. Gross amounts of advance for salam goods and advance for istisna goods at the end of financial reporting period shall be carried at their outstanding amount less any allowance for impairment. Outstanding amounts represent the gross amounts of advance for salam goods and salam istisna less inventories received or other adjustment, including recoveries, discounts, rebates, and performance bonus, if any. Allowance for impairment, if any, shall be accounted for in accordance with respective AOFI. A delay in or inability of the seller to perform delivery of the subject matter of salam or istisna transaction shall be considered as an objective evidence of impairment. Now, let me clarify one part here. We have used the term impairment here. We have not used the term credit loss here. Standard talks about impairment, credit losses, and onerous commitment. Since the amount of recovery is not going to be taken place in form of cash, hence, at this point of time, this advance shall not be subject to normal credit loss, but it shall be subject to allowance for impairment, which means that even if it is expected that the goods are to be delivered, but if there is a risk that goods value may have gone down. So for example, again, we take the same example. I had paid like for 100 BD in advance to Sister Marjan for delivering the apples at that point of time after 6 months. But if I paid the advance, I expected that I will be able to sell those apples for 120, but the market value has gone down, and now it is expected that once I receive it, it will be sold only for 80. It is not a credit loss because she is delivering according to the agreement. This is an eventual situation. In some situations, it can turn out to an onerous situation. In some situation, it can turn out to an impairment. From our perspective, we have used the term impairment here, not the credit loss, where we believe that here in this standard, the term impairment is more relevant. Inventory. Subsequent initial recognition inventory shall be measured at the lower of cost and net realizable value and inventory determination, and any adjustment to bring down the value of inventory to net realizable value shall be carried out in accordance with respective OFI phase. Delivery of the subject matter not matching the contractual specification may trigger a need for reassessment of net realizable value. Any additional handling and holding costs related to inventories shall be charged to statement of income during the period in which these arise. Let me complete this section and then I'll take all the questions. Derecognition. Inventory shall be derecognized when the control is transferred to the eventual buyer in form of sale, or the control is lost, for example, in form of physical loss or theft, or these lost their capacity of providing future economic benefit, for example, technological obsolescence, legal restriction, or if there is no expected buyer. In case of inventory which is perishable, in that situation, even its expiry or it's not in edible condition, etc., they all may be those situations where you need to derecognize them. Advance will be derecognized when the delivery of the intended subject matter or substituted commodity with mutual agreement is complete, when the subject matter is no more deliverable and advance payment thereagainst are refunded with mutual consent, when due to seller's insolvency or other limitation, these cannot be recovered, or when the buyer waives its right by writing it off or gifts it as hiba to the seller. Sister Marjan, just take a note of it. Maybe in the initial section we used in the recognition we applied in advance first and inventory second, I think. So maybe the sequence in derecognition is opposite. We are putting in derecognition of inventory first and advance later. So we need to check the sequence here. Now coming to revenue and profit recognition. Revenue shall be recognized at gross values at the time of sale of subject matter to the eventual buyer. Now we are coming to the main contentious issue of salam accounting. This is according to the current accounting that is there in UFI. This is according to what normally is approved by the Sharia scholars. But I can understand that there are some comments already we are receiving now on this issue. Because, okay, let me put it like this. Forget about a bank. We were talking about a transaction between two persons. So if I paid advance of 100 BD to Sister Marjan, she delivered after 6 months apples worth, apples of that quantity and the specification that we agreed. Now I sold them at 120, either directly or through her as an agent. Forget about I am a bank or not a bank. What would be my accounting? Simply speaking, my accounting according to all accounting standards would be that I do not recognize any revenue till the time I don't sell the asset. Why? Because what is the performance obligation? Performance obligation on her is to deliver the commodity, and for me, making payment to her is not the performance obligation. It's not a conventional interest-bearing transaction. For me, the real situation would be that I purchased the asset and then sold to the eventual customer. That sale is the triggering point for my revenue, which means that this is a shortcoming in case of Salam transaction or similar Istisna transaction, that during the period of deferred payment of delivery, there is no revenue recognized. Why it is not recognized? Because the contractual right to earn revenue does not exist before that date. Making her payment for advance for purchase of goods does not create a revenue event. What creates a revenue event? When I acquired the inventory and I sold it to the eventual customer, that is the revenue triggering event. Till the time that revenue triggering event doesn't take place, till the time, as per Sharia, as per law, I have no right to recover anything. So for example, if due to catastrophe, she is unable to deliver me apples, and if apples are not even available in the market at that point of time due to catastrophic loss, what will happen? She will just return my money. No right of earning revenue is established. Example one. Example two, she delivers apples, but apples are sold at a loss. It means that till the time that eventual sale of apples doesn't take place, till that time my right of ownership on the revenue is not there. So there are explanations. The gross revenue shall be the total amount billed to the eventual buyer directly or through an agent without any deduction of agency fee or incentive payable to the agent. Explanation two, the buyer shall not recognize any revenue, hence profit, till the time the subject matter of the Salam or Istisna transaction is not sold to the eventual buyer. An agent, if any, may be appointed in line with Sharia principles and rules to facilitate the sale of subject matter to the eventual buyer. In practice, at times, the seller of the first leg of the transaction is also appointed as an agent for this purpose. Agency fee, fixed or variable, including incentive, shall be accounted for separately from and hence not netted off with the gross revenue arising on the transaction. This is also an important point. Sharia does not allow you to combine two contracts into one. So at times, banks, what they do, they recognize the net profit and they do not recognize the gross sale amount. They do not recognize the gross sale amount and the a gross sale amount as well as the agency fee separately. Rather, they take it net. Taking it net means you are combining two contracts. One sale contract and one agency contract are being combined together, and you are taking the net effect of the same. And this is one of the things which gives the impression that this was all one single contract. But as per Sharia, it is not one single contract, and it has to be separate contract according to, like, the Sharia principles. So from that perspective, this is to be kept separate. Let me complete this accounting treatment on the buyer side before going for the question and answers. Goods purchased under deferred delivery contracts sold on deferred payment sales. So now you purchased on Salam and you sold on Murabha to somebody else. So what will happen, that the Murabha side of accounting shall be following the Murabha accounting and the FAS 28, but there will be a question that if there was a spot sale profit element, so that spot sale profit element can be excluded and recognized immediately as revenue. So I purchased after Salam after 6 months, and then I sold on Murabha for further 6 months. So now if the spot price at the time of sale on Murabha was more than, to the extent of that spot price, I can recognize revenue after 6 months, and remaining revenue according to FAS 28 will be deferred and recognized over the remaining period. I can clarify one thing. This standard clarifies things. This standard improves accounting presentation, improve some of the treatments which were not specified earlier, but fundamentally does not change accounting according to FAS 7 and FAS 10, which were particularly FAS 7, which was originally the Sharia compliant approach towards accounting for salam. So we have kept the same accounting, but we have clarified it, we have improved it, we have aligned it with IFRS and new framework and everything. But fundamentally, the accounting is not changed. But like, for example, this point of deferred payment sale was understood, but was not clear in the standard, was not written in the standard. That's why we clarified it in the standard and created a cross-reference with FAS 28. Okay, before I go to presentation and disclosure, I can see lot of comments coming up. So now let me just take all the comments one by one. Brother Imran, first point about revenue recognition. Again, this is a bit late, but let me just he has put the question on questions on para 30. So he has gone on the seller side accounting. So I'll come to that later. Let's go one by one. Brother Saeed Imtiaz Hussain Abbas. If the seller could not deliver on promise date due to the construction of project is overrun and the Istisna, what shall be repercussion? Brother Imtiaz Abbas Hussain, this is a Sharia issue. Accounting standard earlier used to address some of the Sharia issues. In this one, we decided that we will not be addressing the Sharia issues. Sharia issues are addressed in the Sharia standard. Sharia standard has specified certain situations for this one that either they mutually agree on the change dates and change specification, etc., or otherwise they need to cancel the contract. Whatever is there, that is written in the Sharia standard. The accounting standard here addresses about what happens when you mutually agree on the change of date, specification, or other terms and condition of the standard of the transaction in line with Sharia principles and rules. That part we address here. So again, it doesn't cancel automatically. Obviously, the compensation effect and all these things are there, which should not be addressed. Subject matter of of the accounting standard. And that is the reason that even some of the things that were included in the earlier FAS 7 and FAS 10, we have excluded them. There is comment from Brother Jafri Kesawani. Since the takaful is part of inventory cost, but some countries only offer conventional insurance due to absence of the takaful option, would such costs still be recognized given that conventional insurance is not Sharia compliant, or should it depend on the specific ruling of the Sharia board? Brother Jafri, you have answered yourself. It's a good point. And I think you answered yourself, because if the Sharia board, given the situation, has allowed this cost to be taken and on the basis of necessity, because they will have to determine the necessity. So if it is necessity, then obviously it will be part of this one. Thank you very much. Brother Sadaqat has a point. Under Salam, if the commodity could not be delivered on its deferred delivery date due to natural disasters such as flood or earthquake, is there any penalty for delayed delivery? Or should this issue is addressed within AOFI standard? Again, Brother Sadaqat, our FAS 7 also addresses this point, but now new one will not be addressing, and it is left for the Sharia standard. Sharia standard actually has addressed the most of the significant situations like this, which happen in that situation. In a nutshell, either they agree mutually on a different specification or a different quantity or different specification or different delivery date, or otherwise they will have to pay back the money. Agreeing on a different specification of goods is helpful for the purchaser normally, because in other case he will get only the money. But in this situation, he can negotiate to get some goods which can be sold still on profit. So change of specification or change of delivery date can still secure some profit for you, or at least reduce the loss as compared to a direct cancellation of the contract situation. Thank you very much, sir. The Sikandar Yusuf Zai has a point. Riba is not profit permitted, and riba is profit. Rabah is profit. Yes. Ahmed Tahir, what is the problem associated with Salam? Brother Ahmed Tahir, I'm not very clear about your question, so you need to explain a little bit more about your question. Brother Muhammad Imran has a question in Istisna. What if payment is in tranches and agreement one time for full stock? Yes, yes. In case of Istisna, it is allowed. In case of Salam, 100% advance payment and the beginning is needed. Brother Ahmed Antele, can I ask a question out of the topic? If you permit me to ask question out of the topic. Brother Ahmed, everybody's time is very precious. We have to complete 2 standards today, and we have not yet completed 1 standard. A little bit break for prayers also is needed in between. To be honest, or maybe we can continue as Sister Syra, did we plan for a prayer break today, or we want to conclude in one go?
We planned for a prayer break, يعني بس قصدي like.
So we'll take a 15 minutes break in between as well. So Brother Ahmed, to be honest, time may not be enough. What I suggest, as soon as we complete the discussion, at the end, you can ask that question, please, once we complete the discussion. So this will be not taking time from everybody. There is comment from Brother Muhammad Aminu Zakari. Yes, it is impairment. Thank you very much, brother, for kindly agreeing with us, because it's a very important point to get input from experts like you. Then we have Brother Abdul Samad Abdullahi Abdi. If the ownership of Istisna raw material lies to Mustasni, the ownership of Istisna raw material lies to, no, it is to Sania. It is to Sania. That is the manufacturer. The ownership of Istisna raw materials is for the seller, that is Sania. Anonymous attendee, dear organizers, it is possible to send presentation. Unfortunately, I missed some slides. The quick answer is that this presentation is not a presentation. It's just the same PDF version of the standard that you have. Standard you can always download from AOFI website. The exposure draft of the standard is always downloadable. So Sister Anouf, if you can kindly put in the chat window, or maybe you can type answer to this one to provide reference, to provide a download link for the standard, please. Okay. Then we have comment from a brother, from anonymous attendee regarding the inventory valuation. Suppose we initially purchase goods at an estimated price and then evaluate our stock at the time based on that price. However, once we receive the invoice and the prices are mutually adjusted by both parties, we reevaluate our inventory. Is this process now compliant with Sharia? No. In case of Salam, in case of Istisna, you have to fix a price and you cannot keep it estimated price and all that, because this is a transaction that takes place on day one. So you cannot keep it open. Further details are addressed in the Sharia standard. For all that anonymous attendees, it's always our request to please put your name and your because that will actually help us making sure that the comment is recorded with your appropriate name. We have comment from Brother Miftahu Dibaba. I have a question that isn't directly related to today's topic, but significantly impacts our work. Okay, again, this question is related to IRR and others. It is related to IRR, investment risk reserve. I'll try to answer it in the end, please. But right now, everybody's time is very important. And then there is a comment from Brother Ahmed Intil. Let me ask you about IRR and PR. If there is net losses not happen during the investment, who is the owner of funds in both accounts? And again, this is the same. But both questions by Brother Muftahu and Ahmed Intili are about IRR and PR. Okay. Actually, I was supposed to discuss this IRR and PR issue. Let me come to that point, because that was not related to what you are asking, but that is related to another aspect of revenue recognition on Salam. Brother Imran, my question was for revenue of profit recognition on account basis, so we do in Musharka before we actually calculate or receive. Okay. Brother Imran, now let me address this issue. How to put it? Accounting goes by accounting triggering events. Accounting triggering events are transfer of control. In case of revenue, obviously transfer of control as well as the 5-step revenue recognition model, things like that. Cash payment is not a revenue recognition item. Am I right? Cash payment is not a revenue recognition item. So, for example, if I gave cash of 100 BD to Sister Marjan for purchase of the apples on Salam, it was not a revenue item for her at that day. Now, when it is a cash item, you cannot recognize revenue on that because it will tantamount to riba. Now, the question that you raised, so it takes me to another wrong treatment. The problem is, whatever you receive on account, mashallah, you are a very learned person. I can see from your questions, you raised some very good questions. And your question itself include an answer element. That is, you said on account. Brother, please tell me, whatever you receive on account, how it becomes your revenue. So thank you very much. You identified a wrong treatment in case of running Musharka also. The problem is we need to understand when your contractual right to earn the revenue establishes. Brother Imran, I'm not sure whether you have attended the public hearings on the participatory venture standard that we recently held. I'm not sure. I think that all the public hearings on participatory venture standard are done, but maybe one might be pending. Sister Saira, can you confirm if there is any pending public hearing on revenue this participatory venture standard?
There are two public hearings,
Two
the
are
Arabic and one
conducted.
English. One Arabic and one English is
Okay,
pending.
so one Arabic and one English are pending. So I suggest, Brother Imran, that you please attend the next public hearing on the participatory venture also, because when you yourself said that we received in on account, it is no revenue. In Ijara, in Musharka, in Mudarba, in lot of other structures, you can receive payments on account. Receiving on account does not generate a revenue triggering event. Not even under IFRS. Now, the problem is at times under IFRS, you consider all these Islamic finance transactions equal to conventional financial instruments. Because we don't believe in Islamic finance. Because we believe Islamic finance is just a bunch of papers that we develop to make fool of people. But if you really believe that Islamic finance is different and this bunch of paper actually means something, then we need to go into detail and try to understand what the transaction structure is and what are the relevant Sharia and legal requirements on that. So the point comes here, but I can tell you that revenue recognition in case of on-account payment is technically not justified because the revenue triggering event has not completed. What is the revenue triggering event in case of Musharka? That is that you calculate the profit and loss of the venture and then you distribute that profit. This is written in our current FAS 3 and 4. This is written in more detail, in more explained form in the new exposure draft on the participatory ventures. So let's try to understand. Conventional mindset, we believe in time value of money. Allah subhanahu wa ta'ala said, you are allowed to earn from trade, but not from riba. Now, when trade completes, when I purchase, trade does not complete for me because trade is purchase and sell. My transaction completes when I sell. So effectively, from the Sharia perspective and from the legal perspective, the revenue triggering event, the revenue recognition event, the asset recognition event asset derecognition event, they all have not taken place. They will take place once I receive the goods and I sell them. In Musharka, the triggering event comes when I calculate the profit and loss and declare how much profit and loss is attributable to different parties. If without doing the profit calculation, or if there is a loss today, but just for the purpose of this, I'm making an advance payment, that is not allowed by Sharia to be recognized as revenue. Because that is not our revenue. Again, there are technical issues. And some of the time we say, oh, it is allowed by Sharia. Yes, Sharia allows this thing. But Sharia allows it as what? The answer lies in your question yourself. It's on account. So something on account, when it comes to accounting, it says it's on account. It is not receiving something on account never triggers a revenue event or asset creation event. Now, this is the most fundamental issue of Istisna and Salam accounting, that we are stuck. We cannot recognize revenue on that part. Yes, I know that a lot of accountants and some Sharia scholars have tried to find some solutions out of that. Okay, we do this, for this is allowed, this is not allowed. Okay. I can answer you what is the view of AOF's accounting board. Just also keep in mind that all our accounting standards are reviewed by the Sharia committee of the Sharia board, which comprises of 5-6 members from the Sharia board and couple of more members, scholars from outside. They review and they confirm that this is according to the AOF Sharia standards. So from our perspective, our financial accounting standards are also Sharia standards addressing the accounting part. The framework contains a whole chapter on how Sharia rules are translated into accounting principles. We have to follow that. And we are not answerable for the views taken by other scholars. If some scholars take a view, obviously we cannot answer that. We can simply say that this is the correct picture. This is the correct regulation. As per Sharia, it needs to be done this way because the Sharia basis of transaction are translated into accounting this way. Now, there is a question people say, and now I want to touch the one part of the other topic that some people have touched upon, is that, okay, if you do not recognize any profit for 6 months, 9 months, what happens? It will discourage Salam and Istisna transactions. Our answer is this discouragement should not lead us to doing something which may tantamount to haram. Rather, we need to find models to structure it in a way that this thing does not impact the average returns, etc. That is the concern. First thing, we should forget from our mind that, which is the conventional mindset that is in our mind, every rupee or every BD has a right to earn more fulus every day. That is conventional mindset. Money by itself, as per Sharia, has no right of earning money on it. That is riba. That is prohibited. Sharia says you convert money into different assets and services and transactions and ventures, and out of that you make money. Sharia does not say allow you to make money on money by just making a bunch of papers. So here still solutions can be there. We can find solutions. Solution lies in finding a better managed way of keeping a Salam and Istisna portfolio, which gives you an average return over a period of time. Solution lies in creating appropriate IRR and PER, particularly profit equalization reserve, to manage the spikes that would be coming in the average return. So Sharia allows you to have profit equalization reserves. So you can create profit equalization reserves to manage the spikes in profits and losses for the purpose of investment account holders. But saying that, oh, since this is the issue of investment account holder, we need to give them return. Wallah, as per contract, you are not required to give them return. As per contract, you are required to give them what is calculated as a return attributable to them. We want to do Islamic banking only by name. All the time we listen to people saying, oh, we have to give return to investment account holders. Wallah, if your contract is true and you are true to your ambitions for Islamic finance and you are true to Allah Almighty, then you are not required to give any return to investment account holders unless it is calculated as a genuine Sharia compliant profit for them. Otherwise, the contract says that they are entitled to profits and losses. The contract says that their principal amounts are not guaranteed. But wallah, we just want to make fool of people, and that is the reason that we insist again and again and again, oh, we have to give return to investment account holder. But yes, Sharia does not ask you not to do appropriate risk management measures. AOFI has already issued FAS 35 on investment and on the risk reserves, which addresses the investment risk reserve and profit equalization reserve. Those who are interested in the subject are requested to read the FAS 30, Financial Accounting Standard 35. It addresses how we should maintain these things. It is recommended that we should maintain reserves. Accounting cannot make it mandatory to make reserves, but it is still recommended. But the point is, if you want to have this solution, the solution does not lie in doing wrong things. Solution lies in doing the things in a right manner. And that is where we suggest that appropriate portfolios for Salam and Istisna should be there, and appropriate risk reserve should be maintained to adjust the spikes issue. But taking this plea that, okay, we have to give return to the investment account holders is not the right plea on this point. Brother Muhammad Imran, thank you very much for raising the question. My apologies are for sure if I have become harsh in some of my comments. It was not intended for you. It was intended for the general comments that we receive on this point. So my apologies if you feel offended for my comments being harsh. We fully understand that you are committed and you are asking a question that is based on the current practices. We just want to clarify that what is right as per our understanding. Okay, there is another question by Brother Imran. My question is for purchase side profit recognition, that purchase recognizes when paid or received inventory before ultimate sale. No accounting standard in the world allows you to recognize profit or loss on the inventories. On the inventories, inventories are not not a fair value thing. They are kept at cost, lower of cost and net realizable value. In no accounting system in the world, inventory is kept on fair value. However, now there is a question. If we create an accounting system which keeps inventory at fair value, the point is that you need to understand the cost involved in keeping that fair value would be much more than what we are doing. So it will be hypothetical fair value only, or we'll just start discounting the eventual sale price. That is where we do not believe. Although from Sharia point of view, if you ask me, this is my view, not the view of the accounting board at this point of time, but from my view, since Sharia requires inventory to be zakat on inventory to be paid on fair value basis, so I personally believe that Sharia has this acceptability for fair valuation. But fair valuation of this one should not be the discounted value of the sale price, because sale price is your specific entity specific. Fair value is market specific. You need to go to market and check for everything. That is the reason that anywhere in the world inventory is not kept at fair value, except for even in case of real estate. If you have a real estate investment, that is kept on fair value, but if you have real estate inventory, it is kept at cost. Why? Because this is your business model. Your business model is to purchase goods and sell them, and the performance obligation 5-step criteria is met according to that. So if you ask me, if I go out of the overall IFRS model, overall accounting current regime, and I want to develop a new accounting model, I can say that yes, fair value for inventory might be acceptable because that is acceptable for zakat purposes, or that is required for zakat purposes. But the point is, if I do that, I'll have to change the whole accounting regime. Okay, so thank you very much. I think it's a good point, but given the current accounting structure, it is not allowed. Brother Sadakat has a point, revenue and profit recognition. If the purchase price was paid on 1/10/23 and delivery was received after 6 months on 1/4/24, commodity sold on 1/5/24, profit amount 10,000, how the income should be recognized? Full income on 1/5/24, or can it be split into 23/24? It is a single transaction, sir. So from that perspective, it cannot be split. It has to be recognized in one go, as I explained earlier. Thank you very much, sir. Now the point, the discussion is getting interesting. The questions are getting interesting, but this is like, the challenge that we have to complete 2 standards. So I'll just pick and choose the questions which are relevant, and irrelevant questions now I will drop completely. My apologies for that. Brother Sadakat has a point about the presentation and disclosure, that he also suggests to disclose the type of salam goods and istisna good to improve the level of transparency in the disclosure for satisfaction of all stakeholders to a Sharia compliance. Sir, we will put it as we can suggest to put it as a preferred disclosure, but not a mandatory disclosure, because mandatory disclosure may make it very difficult. Now on the presentation and disclosure, I'm not going for all detail. We are asking for accounting policies. We are asking for disclosure about advances, about commitment, about liability, about impairment, about net realizable value of the inventory, and also disclosure about the agency related amounts. I think font sizes, Sister Marjan, you need to check, Noof and Marjan, you need to check the font sizes here. They are not consistent, but as overall, I'm not going in detail about the presentation and disclosure. If anybody has a comment, please give it, because at this point of time, we are running a bit late. And my suggestion is that we don't take a break and we try to conclude by 12:45 or 12:50 maximum, rather than taking a break now. We can like, pray after that. That would be like, a bit more possible thing right now, because otherwise it will become very difficult to take a break and then join back and close the discussion. Now coming to the next part in the books of the seller. Now for the seller, we have identified the counterparty accounting. So these sections are about the counterparty accounting on the other side. So this is normally a contra accounting, what would be there in line with generally accepted accounting principles. So in case of advance payment received, you will record a liability of salam goods deliverable. In case of istisna transactions, you will mention as istisna goods deliverable. In case of salam and istisna goods deliverable, subsequent to initial recognition, liability shall be measured at its outstanding amount. And onerous deferred delivery sales contract, this is the situation that you have a delivery due, and for that purpose your cost is increasing, or you need to purchase things and your cost is increasing. So there is a loss element coming. So as soon as that loss element is identified, you need to recognize that loss element as onerous commitment at this point in line with the relevant standard, that is FAS 30. Generally accepted accounting principles shall be applied in case of accounting and financial reporting for inventory, etc., like at lower of cost and net realizable value, and according to whatever is the process, like like under growth as an agriculture produce or in process, whatever are the requirements of the respective standards, those will apply. insofar as they are not against Sharia. And generally, we believe that these are principles that are not against Sharia. So these will be applicable as normal. Revenue shall be recognized at the time of sale of subject matter to the buyer, which shall coincide with the time of transfer of control. Brother Harun, if you just recall, Sister Marjan and Sarah, just make a note of it. But I think we might need to improve the wording at the time of sale here, because as per Sharia, here we are talking about time of delivery, not time of sale. Because time of sale, as per Sharia, original time of Istisna sale is sale consummation. So we say that it consumes the sale, but the time of original sale is when you actually pay the advance. So here we might need to find more appropriate wording in line with the comments of the Sharia committee. So revenue and profit recognition will be done according to once the goods are goods are delivered and your performance obligation under the sale is met. Either we use this term that a performance obligation under the sale is met, that is delivery of the goods. So I think that should be more appropriate wording here. I think it's only the issue of wording. Other than that, conceptually there is no difference between what we wrote and what was agreed with the Sharia committee. In case of Istisna, if there is a deferred payment element also that can be segregated, because in case of Istisna, there can be a deferred payment element here. In case of Salam, it cannot be, because in case of Salam, you have received all the amount in advance. You are the buyer, you are the seller here. So as seller, you receive the advance amount for Salam. So technically, there is no issue of deferment here. But in case of Istisna, it is possible that I did not receive the total amount of advance payment and maybe partial is deferred. So the deferred payment accounting to that extent might be relevant. And to that extent, as we discussed earlier, the relevant to that relevant element, a deferred payment in line with FAS 28 would be applicable. Then we have the presentation and disclosure requirements. There was one specific comment at para 30 also. Para 30 comment was, I think generally I answered that point, but Brother Imran has point, revenue shall be recognized at gross value at the time of subject matter to the buyer. Why not we think to recognize revenue based on provisional profit distribution of depositors like in Pakistan is being done for running Musharka? I think your Brother Imran, again, your point was linked to the point that we already answered, but this is for the buyer, not for the seller. And sorry, for the seller, not for the buyer, which means that here the seller might just be growing it on trees. Like in the example I took with Sister Marjan, she is having trees, having apples under growth. So how you can have a proportionate profit on that part, under which accounting treatment? I don't think it will be justified under any. Brother Saeed Imtiaz Abbas Hussain has another point. Can the buyer add takaful coverage expenses and fixed costs of deferred product and Salam Istisna to mitigate the possible risk of losses due to deferred delivery of product? It's a very good point that but this is a risk cost, not a cost. So yes, a coverage, if you can get a coverage. So for example, Sister Marjan takes a agri takaful policy for the trees, because she wants to just make sure that if there is a risk of loss, that can be recovered. So yes, it is possible for her, but will it be added to the cost of cost for her? I think it will be indirect cost for her, not a direct cost for her. But again, this is a good point. Yes, this will be a cost and this can be a cost, particularly in case of agri. In some cases, it might be even in case of Istisna, etc. When you are in the mid stage of manufacturing the asset, you might still need to keep the insurance coverage, the kaful coverage. So yes, the point raised is correct. And whether it's a direct cost, the condition, Brother Imtiaz, let me take you back. The condition to bring the asset in the present location and condition. So it was not essential to bring in the present location and condition. It was just to manage and mitigate the risk of delivery. So from that perspective, it is not the part of the cost. It will become eventually an indirect cost, not a direct cost, not an inventory cost. Thank you very much for raising a very good point. I think I'm able to answer this one. We have a comment from Sister Rabia Fatma, Rabia or Rabia or Rabia. My apologies if I like mispronounce any of the names, because people join from different parts of the world. Sometimes the names are new. If I mispronounce any name, my apologies for that. How can Istisna contract mitigate risk in deferred delivery sale while ensuring Sharia compliance? One example, as just I answered from Brother Imtiaz Abbas Hussain about the takaful coverage. With regard to the profit risk management, it can be profit equalization reserve and investment risk reserve to be maintained. With regard to other risk management, again, there will be more of the operational risk management techniques, because you are manufacturing, and then you are purchasing, and you are selling. So some of the operational and business risk elements will also have to be there. Thank you very much. I'm sure I may not be able to answer all the situations while you can do it, but some general risk mitigation techniques that are applicable on the operational side would generally be applicable, including the takaful coverage. Okay, so here I would like to just quickly move to the next section on the presentation and disclosure and other sections that, due to scarcity of time, I will not be covering in detail. I'll be just requesting that you please kindly provide your comments in writing on those. In case of parallel salam, earlier the standard was defining a whole accounting, but now what we have said that since we have defined the buyer and seller accounting, you simply do buyer and seller accounting without combining the contracts. That is it. So you do the buyer accounting, you do the seller accounting, and you don't combine the contracts. This is just the requirement. That is a mutually exclusive basis. Same applies to parallel istisna. So we simplified that part, because earlier parallel salam and parallel istisna accounting were defined. They were making a few things more complicated. But now in this standard, we made it simplified, because both sides of accounting are defined. You just follow the respective side of accounting on the transactions. On a mutually exclusive basis means that Sharia does not allow you to combine the contracts, so you do not combine the effect of the two transactions. Consider both of them independent of each other. With regard to the subsequent changes, earlier the standard addressed some of the issues with regard to what happens this way, what happens that way. So if there is any subsequent change in the contract during the specification of the good and that event itself shall not give rise to gain or loss at that time. Rather, once you receive the goods and sell, then obviously the gain or loss will be changed. But we have simplified this accounting requirement very much here. Change in price also, that in case of istisna, there is a possibility of change in price, what we call shart jazai, or the performance bonus. So whatever is allowed as per Sharia principles and rules, that is to be accounted for in line with requirement of paragraph 38. That is, it does not give rise at that point of time, but it gives rise to the eventual profit or loss on sale. Effective date of the standard is proposed to be 1 January 2027. We intend to finalize it within 2025. So we expect that if it is finalized within 2025, there will be enough time available for implementation. By the way, I would still say that this standard does not significantly change the accounting requirements. The only thing is that some of the istisna transactions which are currently under FAS 10 may be allowed a percentage of completion method, but after these two standards, only those who meet the conditions specified for istisna-based development contracts will be eligible for the percentage of completion method, which will be generally long-term. Some of the conditions I mentioned earlier. Here, I'll just stop with the first standard, and I'll move to the second standard, and I'll just take you through this one. Okay. Just to confirm, you all can see the screen. The second standard is on screen now.
Yes.
Okay, thank you very much. Okay, so now the name of the standard is Istisna-based development contracts. Is there any better name? Sister Marjan, can you recall what were the names under discussion at the working group? One was long-term istisna contracts.
Yes,
One
sir.
was long-term istisna contracts. One was long-term Istisna based development contracts.
Yes.
And what else?
Just these, brother. We had concerns about the use of the word development as well. Manufacturing was also
Exactly.
discussed.
Manufacturing was also discussed, that construction or manufacturing, construction contracts also. So we would appreciate receiving comments if you feel that this name is good enough to understand what type of contracts we are talking about, or do you feel that some improvement is needed? Please let us know. Okay, now let's go to the. I have already provided combined introduction about this and all that. So, but let me still take you through the significant changes. Deferred delivery sales transaction based on Istisna, which are generally short-term in nature and do not meet the criteria for Istisna-based development contracts, are not included in the scope of this standard and are subject to requirements of FAS on deferred delivery sales. The financial reporting requirements prescribed by revised standard are aligned with requirements related to control, transfer of control, and revenue recognition, etc. as per new standards. The predecessor standard included Sharia requirements, which we have removed. Relevant definitions have been aligned with the new ones and with the Sharia standard. The revised standard prescribes financial reporting requirement from both perspectives. Earlier, it was Istisna and parallel Istisna. Now we define the developer and customer perspective. So we consider two terms, developer and customer. Parallel Istisna, here also we made it in the similar way. The revised standard aligns requirement related to impairment, credit losses, NRV. Other changes are more or less the same as we discussed in the other deferred delivery sales standard. The objective of the standard is to prescribe the appropriate accounting and financial reporting principles for recognition, measurement, presentation, and disclosures to apply in relation to Istisna-based development contracts for the developers, contractors, and customers for such transactions. We have used the term contractors only at one place here, if I'm not mistaken, just to identify it. But other than that, we have insisted on the using of word developers and customers. One of the reason of not using it was that in some situation, the customer can also be contractor. That's why because in case of parallel Istisna, a customer in one contract will become contractor in the other one. So that's why we use the term developer and customer rather than contractor and developer, although we used the term contractor at one place here. This standard applies to accounting and financial reporting for Istisna-based development contracts, see paragraph 5, carried out under Sharia principles and rules by IFIs and other institutions allowing following AOFI phases, except for those Istisna transactions that are excluded from the scope under paragraph 3. This shall not apply to where the Istisna transaction do not meet the criteria of an Istisna-based development contract and hence are subject to accounting as a deferred delivery sale transaction that we already discussed. Which one? Such Istisna transactions that have a total delivery period of less than such Istisna transactions that have. Okay, sorry, whereby, sorry, so it's okay. Hereby such Istisna transactions have a total development period of less than 12 months, even otherwise meeting the criteria of Istisna-based development contract, which shall be subject to accounting as deferred delivery sale according to the requirement. So now this is a condition, and this is one of the areas where we would love to have your comments, that our suggestion, and this one is that we wanted to keep maximum under deferred delivery sale, only long-term transactions are to be kept here, for which we created this scope exclusion of 12 months. This means that if you have a construction contract of like 8 months, 9 months, which may be even spreading over 2 financial periods, because that is still the revenue will be recognized at one single spot, one point of time. Now, this is something that if you create an exclusion for this one, then one of possibility will be that the time-based criteria, if you just make it shorter time per possibility also, the problem is that some of the conditions may not meet, and the general criteria about income recognition which is on the delivery of the asset would not meet. So there is a lot of confusion on this part. Again, we would like to have comment on this point particularly if you feel that 12-month criteria is helpful. But let me clarify one part. When our FAS 10 was based on International Accounting Standard 11 construction contracts. Construction contract accounting under IAS was all stage of completion method. Now, what happened that when IFRS 15 came, the International Accounting Standard 11 was abolished, superseded. IFRS 15 allows percentage of completion method only on very limited situations. We believe that Islamic finance unique product structure and the business model might still require some flexibility on that part. And that was the reason that we are bringing this standard. Otherwise, it would all be deferred delivery sale, but it will significantly discourage long-term Istisna transactions. And from that perspective, we believe that we need to come up with accounting which is significantly aligned with IFRS 15, but provides a reasonable level of flexibility for Islamic financial institutions and transactions, including sukuk, which are having a Istisna-based structure. 12 months is kept as a scope exclusion, not as a part of the definition. Earlier, we considered the term as long-term Istisna-based development contract, and we considered 12 months as even as a part of definition. But now we have put it like, as more as scope exclusion. The question with regard to whether this is clear to you, whether it needs further clarity, some guidance, please let us know about these issues, because these are very complicated issues. We know that not all transactions will fall in this one, but transactions like Islamic development banks have huge infrastructure transactions, some of which are based on Istisna. They may be impacted. Some of the Istisna-based sukuk and long-term infrastructure projects may be impacted. And one thing is important that we want these are the genuine Islamic finance transactions. We want them to grow. We want them to be nurtured. And that was the reason that we felt that if we put only one bullet stage revenue recognition for these transactions also, it will not be justified according to the business model, and it will not be sort of encourage, rather it will discourage the Istisna transactions. And that is the reason that the accounting board decided to come up with this standard. And these are some of the areas where your specific comments now or in writing are requested. Then there are two other exclusions, like when you have Istisna ka Ijara, which will go to FAS 32, and if you have Istisna and then you use it for your own operation, that will also not be part of Istisna. I think I have one comment coming up, Brother Muhammad Akmal. Just a suggestion, we could have a prayer break, as in Pakistan might be shortage of time for prayer. Okay, the problem was that, Brother Muhammad Akmal, my apologies, I just saw the comment now. It's just 5 minutes back, but our apologies. We are doing with the Central Bank of Pakistan support, so we know that a lot of people today have joined from Pakistan. Originally, we planned a break, but considering some of the time constraints that I realized, we decided to close it early. So we'll just close maximum in 20 minutes or so at 12:42, 12:45 maximum. We'll try to close, so please bear with us. Now, coming to definitions, the customer in the specific context of the standard is the buyer who acquires the subject matter under an Istisna-based development contract. Deferred delivery sales we discussed already, so I'll not repeat. Developer in the specific context of the standard is the manufacturer, constructor, producer, processor, fabricator, or builder, etc., who develops and sells the subject matter under an Istisna-based development contract. Developing is not the condition. Developing and selling is the condition. So if I develop and then I give on Ijara, it is not under this contract. If I develop and use it for myself, it's not under this one. If I develop for others under agency, that is service Ijara, that doesn't come into this one. here it applies who develops and sells. Okay. Istisna definition is covered. Istisna-based development contract is a contract of Istisna for development of an asset meeting the criteria defined in paragraph 5. Paragraph 5 criteria we already discussed while discussing the earlier standard. Parallel Istisna we discussed already. A stage of completion method, also at times referred to as percentage of completion method, is the recognition of revenue and expenses by reference to the stage of completion of a development contract. Under this method, development contract revenue is matched with the development contract project cost incurred in reaching the stage of completion, resulting in the reporting of revenues, expenses, and profits, which can be attributed to the proportion or stage of work completed. Any comments on these definitions and the initial points? Okay. So now we come to the main accounting. First criteria. Criteria we discussed already. In the footnote also it should come like this, like in bullet points. Okay. Is the in the footnote in the first standard. Istisna-based development contract within the scope of the standard is a contract of Istisna for development of an asset, normally an item of property, plant, and equipment of or investment property, duly meeting the following criteria. A, significant element of efforts on the part of the developer. Now, this is the justification for recognition of revenue over a period of time. Why we are distinguishing it from the others? Because this one in Istisna, again, some of the Istisna may require a very minimal level of effort. So for example, it is quite possible that there is 99% of the like, for example, if I just have import a CKD kit for a car and I join the parts. Yes, effort is there, but that is not that significant effort. So a car manufacturing based on CKD kits might not generally qualify for this contract. That might generally go for deferred delivery sale. But here we are talking about a significant element of efforts on the part of the developer, including labor and services, which need to be compensated for in the case of force majeure in line with Sharia principles and rules and customary practices. So the question is, I completed half of the work. Sharia, general view of Sharia is that in that situation, is still some compensation in form of ijratul misl, etc., might be needed. And these are the things that are the compensation part. Again, that is not the primary basis, but this is the point that we are putting some justifications, that what are the main justification that take us from the requirement of the deferred delivery sale to this one. Deferred delivery sale is 1 point revenue recognition. Here we have over a period or a stage of completion revenue recognition. So what are the justifying factors? Significant element of labor and efforts, including obviously the time that we had put. Actually, we had suggested originally in the definition that 12 months should be a time period as a definition part as well, or criteria part as well. We would like to request you to particularly comment on the 12 months condition part, that whether it should be a scope part or you believe that it's a criteria part. It has either an element of partial control transfer through milestone-based delivery. So the contracts, even if under the contract there is a milestone-based delivery, that is even accepted under IFRS 15 also to be recognized based on milestones. So if it has partial control transfer through milestone delivery, or if you are constructing it on a specific person, a specific customer's property. So you are developing a dam for a government. Now you cannot take away the incomplete dam. It is already being developed on the land or provided by the government. So effectively, there is no other buyer for that as well. So that is the situation that we are saying that otherwise defines multiple performance obligation as part of the contract that may individually be assessed and used as criteria for determining stage of completion. And the subject matter is intended to address certain specific need of an identified unique customer, and hence may generally not have a ready market or may not be in a position, condition, or location suited for its sale to a third party. And has a considerable original total development period comprising of a single or multiple phases. Explanation: development period in this context shall not be confused with the delivery period. So you can, I gave you example of car. So a car may be requiring just, you need to put together the parts, which may takes like, 1 week or 1 month maximum. Even 1 month may be too much. 1 week is needed just to put together the parts. While 99% of the thing is actually the parts that are required already through a CKD kit. Now, that car, due to delivery delays, may be delivered after 1 year, after 2 years. That delivery period versus development period are two different things. So considering the development period and delivery period is both have their significance, but for the purpose of criteria here, it is about development period and not the delivery period. So now if you have a salam for more than 2 years, what happens? Because salam has a delivery issue, not a development issue. Salam does not have a human element part here. So that is the reason that it is salam will still not be there. Again, salam has other conditions as well. This standard applies only on istisna. Now, development to contract project costs. Now, I will just take you through quickly for this one. This accounting is significantly aligned with the construction accounting, construction contract accounting under IS 11. It's more or less the same accounting except for a deferred profit element. So development contract project costs recognized and asset shall comprise costs that are incurred directly on the subject matter of the specific transaction, indirect overheads, and such other costs that are specifically chargeable to the customer. So that is the development contract project cost. Then we have general and administrative expenses not to be part of it, and it may be reduced by any incidental income. So while you were reducing it and you were using a crane, you used crane for another purpose as well. So you can reduce that cost and you should reduce that cost to that purpose. And development contract project costs include the costs attributable to a development contract for the period from the date of securing the contract to the final completion. Costs directly relating to securing a development contract, such as legal fee, etc., are also included in past of development contract if and only if the same shall be separately identified and measured reliably, and it is virtually certain that contract will be secured. Receivables from customer. Now you are, whatever you incur, you put in the cost. Whatever you bill to the customer, you put in a progress billing account. Progress billing does not mean revenue. Let me explain again. Progress billing is on account. It may be equal to revenue, it may not be equal to revenue, but progress billing is done according to the contract. So at times there is an advance payment. So when you put advance payment billing, that is part of the progress billing, and you put stage by stage, normally progress billing is in advance because against the work that is to be done in future. That is the reason that progress billing does not create revenue event, and it is just recorded as a liability. At the end of each financial reporting period, development contract project cost in respect of each development contract shall be carried at cumulative cost less allowance for impairment. Impairment shall be calculated as per relevant phase, and if there are delivery issues, etc., or contractually agreed payments are not received, still there is a risk of impairment. Development contract project cost as subsequently measured shall include the cumulative amount of periodically recognized development contract profit. So then at the end of each period, you will calculate the percentage of completion, and according to that, you will have to add the development contract profit into that cost element. Receivable from the customer shall be subsequently measured. So progress billing is a liability and receivable from our customer is receivable. That receivable is turned into cash. If there is still a receivable and cash is not received, that will be subject to testing for credit losses, because this one is subject to credit losses. Do we have any comment or question? I can see one question. Brother Sayyid Imtiaz Abbas. There is confusion that it's difficult to draw a line between development contract more than 12 months, usually for construction project, and trading contracts less than 12 months, as construction projects are trading, not fixed asset project for construction entities, which goes more than 12 months. So there is no need to create a new standard. Brother Imtiaz, the question is, The question is the conditions that we are talking, even if you forget about 12 months condition. Let me put a counter question to you, and then I'll explain a few more things. So in paragraph 5, we have the criteria. According to IFRS, generally now you have very clear situation that most things have to go according to the obligation. You know, what is the performance obligation of the contract? So for a Istisna contract, performance obligation is what? Delivery of asset according to specifications. If we go purely as per performance obligation part, all will go to deferred delivery sales, which means all of them will have a revenue recognition only at the time of, not at the time of delivery, but after delivery at the time of sale to the eventual customer. Short term, okay. Long term infrastructure products, that is the problem. Here, the business model of Islamic finance is different. Because of that Islam business model, we at times justify slightly different treatment from IFRS for that reason. Yes, we know the 12 month is one of the points. 12 month is not the main point. And that was my question, brother, that whether we put 12 months into the criteria or in the scope exclusion. But 12 months is not the main point. The main point is considerable effort and considerable development period. So if you want us to exclude completely the 12-month criteria, there will be two options. Every Istisna comes here and we keep a complete Istisna transaction Istisna standard, which will be based on percentage of completion, but we may not have enough justification for it under IFRS framework, and it will become a significant deviation from IFRS. Or we put all of them in deferred delivery sale, which will make it difficult for the institutions to go for any long-term Istisna transaction. So I would love to have more comments from you based on my counter question before I conclude your close your question and conclude it. Anonymous attendee, is it permissible to include payment terms such as 2% discount when payment is received within 14 days, for example? In case of Istisna, it is allowed based on delivery, not based on payment. Giving a voluntary discount is possible, but putting two different purchase prices as per Sharia, as per UFI standards, is not allowed. So what we have talked about is about, in case of Istisna, a deferred delivery or early delivery, late delivery or early delivery need to be compensated, or there can be a penalty for that. And that is just, Brother Imtiaz, particularly note down that this is just one of the conditions that we believe that Sharia does not allow you to change the purchase price or put two different purchase prices. But in Istisna, Sharia allows it because Sharia acknowledges that in Istisna, there is a significant performance element. Since that performance element is there in Istisna, if that performance element is significant and there is a significant development period involved, that is the reason that we said that we would be okay to go with the percentage of completion approach. This is one of the justification because of the unique nature of the product and because of the unique business model. Many banks, anonymous attendee, many banks financial statement present Istisna as financing asset rather than WIP. Please enlighten on this. Our new standard says that that it will be said as advance for Istisna till the time there is no progress update. When the progress update is there, then it will become the Istisna work in progress. Istisna work in progress is also important to be identified for the purpose of tangibility criteria, which impact some of the banks and some of the like, Sukuk and other structure also need, like, the Istisna work in progress to be identified separately. So once it comes to a Istisna work in progress stage, particularly when the stage-wise delivery or milestone performance obligations are defined, those are the situations where Istisna work in progress account gives you a leverage for the purpose of tangibility, so it's better to account it for. The standard requires it need to be initially it has to be advanced but later once the progress is identified, based on that you need to put it as a work in progress. Development contract progress billing at the end of each financial reporting period shall be reported as cumulative amount less cumulative amount of accrued receivable and billed revenue against development contract progress, whereas a net liability shall be shown as development contract progress billing liability net, or a net asset shall be shown as accrued receivable and billed revenue against development contract less. So either of it will be coming. Development contract revenue. The development contract revenue at the end of each financial reporting period shall be recognized on a stage of completion basis if and only if A, total development contract cost can be measured reliably and it does not exceed the total development contract revenue. The stage of completion of the subject matter of the development contract can be reliably measured through pre-agreed project milestones, or in the absence of the same through reasonable estimates based on engineering surveys or estimates of cost incurred, and it is probable that future economic benefits will flow to the enterprise, to the institution. Accrued receivables against development contract shall be recorded as receivable against the development contract progress. There is a rebuttable presumption that all Istisna-based development contract revenue may always be reliably measured. However, in certain circumstances, when variation in revenue are expected or variation in delivery date, extra work or change in specification, etc., prudent estimate of revenue shall be applied for the purpose of application of stage of completion method, unless and until the time a higher amount of contract is virtually certain. In case of mutually agreed changes in development contract price and total expected revenue, any such changes shall be incorporated in the total amount of expected revenue as and when contractually agreed. The deferment element, as we discussed earlier also. So in case of Istisna, there can be additional deferment element as well. So if there is additional deferment element as well, that can be accounted for in line with the requirement FAS, particularly FAS 28. I'll not go paragraph by paragraph here. I'll summarize. I have already summarized the accounting. Development contract cost of revenue at the end of each financial reporting period shall be recognized on a stage of completion basis corresponding to the development contract revenue if the conditions prescribed in paragraph 18 are satisfied. The development contract cost of revenue may include an additional cost element in case of onerous situation. Stage of completion method need to be applied in a way that contract revenue is recognized in the statement of income at the relevant financial reporting period in proportion to the stage of completion, and the project cost is also recognized as an expense in proportion of the same. If there is a onerous loss situation, mean that today you expect that the end result of the Istisna contract is a loss. We are the developer. We know the selling price. We might be trying to increase the selling price, but at this point of time, if we know that this is the amount of sale that we have to, and this is the total cost, which is what we call cost overrun, and there was a question on that as well. At this point of time, we will have to recognize the whole amount of loss. The recognition will take place at the time of handover or in case of cancellation, that applies. And inability to assess the stage of completion. Now, this is a very important point. In a nutshell, this section explains that if stage of completion is not identifiable at any stage for different reasons, then you have to cease revenue recognition based on that for one period. And if it is not possible for long term, then you will have to go to the deferred delivery sales standard. Then we have the presentation and disclosure requirements. The requirements of this standard are 90% similar to what was already there in FAS 10 and what was already there in International Accounting Standard 11, which is now superseded. Yes, we have clarified the things, we have realigned the things, but on an overall basis, the standard is taking taking the same route and same approach. I think that based on our discussion, I have to stop my presentation here. Obviously, there are more public hearings to come, inshallah. We'll be able to have more comments. We'll request you to provide comments in writing as well. Now I'll stop my presentation and we'll take only the comments which are already raised here before we conclude. Brother Yusuf Sayed has a comment. What if there are provisions in the contract for escalation or if there are wastages like construction in progress? Brother Yusuf, excellent point, very highly recommended. You have raised very appreciable comments. First point, number one, provision in the contract for escalation. Brother, as per Sharia, based on delivery period, what we call also shart jazai, that is by some scholars call it shart jazai, that is a performance based element. So it can be based on delay. It can be based on delay, a lesser price, or based on early delivery, a higher price. That is allowed. But the Istisna contract is an absolute sale, which means escalation clauses should not be there as per Sharia standard. Am I clear? Let me clarify again. It's an absolute sale, which means that the risk of profit and loss is in the hand of the seller. If you want escalation clauses, it would technically not be Istisna. You will have to go to service ijara based contract. But as per Sharia, price need to be fixed. However, if the price is increasing and you want to renegotiate and you keep an option of renegotiating, that is something different. But those escalation clauses as per Sharia standard are not there. Sharia standard allows you different prices only into in situation of performance, early delivery, or late performance, late delivery. Secondly, if there are wastages or anything, wastage of time, wastage of material, whatever, that is the risk of the seller. This is the Sharia condition and the standard addresses in the same way. Okay, Brother Imtiaz Mustafa Hussain has, yes, you mean this ED as an Istisna based development contract is in place of construction contract standard in which project period runs more than a year. Development contracts are broader term than construction contracts, so it is good. Thank you very much, sir. Thank you very much for all your good comments. Somebody is asking, Brother Muhammad Mahmoud Tarore, he's asking for, I think he's asking about translation in Arabic. Arabic public hearing date is not yet final, I think, but I think tentative date is final. Sister Noof, if you can provide the next public hearing dates, which are tentative dates as of now for Arabic and English, it will be good for the audience. We have comment from Sister Rabia Fatma, with the rise of digital finance, do you see potential for blockchain or smart contracts to improve transparency and efficiency in Istisna contracts? This is something that I cannot comment. We need to go in more detail about this, specific comment for your, how it would impact in your view, and then we see. So I think one thing is for sure, things are changing. The way things will work in next few years will be different. So we need to be open for that, and we need to open for discussion, for evaluation of the comments. So we'd love to have more comments from your side on this one. Thank you very much. Brother Yusuf, you are most welcome. So here we have completed our today's discussion. I'm just closing 15 minutes before time based on our discussion because we are running late for prayers in some of the markets. So we need to just close the meeting today. Sister Haura, back to you for closing remarks.
Thank you very much, Brother Omar, for the insightful presentation and the Q&A session. We would like to thank the State Bank of Pakistan, Dr. Zahid Al-Rahman, all the participants, and all our colleagues here in AUFI. Inshallah, we see you again in the future in other public hearings. Assalamu alaikum wa rahmatullah wa barakatuh.